Okay, folks, last session before the break, right? Couple of things. One is you probably noticed I did not send you a valuation of the week yesterday, partly because there's no chance you're going to look at it over the break. But I will put one up during the break maybe, or when we come back. So I'm holding off, holding pattern on that one. But today we're going to talk about actually doing the part of your project where you need to get done, getting a valuation of your project. Before we do that though, because in today's class we're also going to talk about what I call loose ends, I'm going to throw a few questions at you. Very simplistic questions. Let's say you're thinking about investing in a closed-end mutual fund. You know what a closed-end mutual fund is? Traditional mutual funds, most mutual funds are open mutual funds. So if you send your money to Fidelity Magellan, what happens is the number of units in the fund expands and you get a share of the net asset value of the fund. A closed-end mutual fund is actually a publicly traded company. You buy shares in the company, they invest your money in publicly traded stocks. So it's the easiest of all companies to value, right? You own 10 publicly traded stocks, you can see the market price of those stocks. So let's assume you're investing in a closed-end mutual fund. Invest in stocks. Your required return, given your risk-free rate and risk premium, is 10%. That's what you need to make to break even. This fund is run by a guy called Omaha Oracle. I'm not even trying that hard to disguise who it is. And he's historically earned 2% more than whatever you need to make. So if you need to make 10%, he can make 12%. If you assume zero growth, let's make this a simple math problem. Can you tell me what premium this fund will trade at relative to its market value? Because remember, the market value, relative to the value of what, so it owns $100 of stocks, you're investing in it. I'm going to argue you're going to be willing to pay a premium. And if you buy into that argument, I want you to tell me how much the premium is. How would you solve this problem? What did you do?
2%.
No, it's actually more than 2%. Right now, you're going to, so let's play a game. Let's assume you invest $100 in this fund, right? What are you going to make each year on an expected basis? $12 a year, because he's going to make 12%. Remember, he makes 2% more. So you make $12 a year. That's your cash flow every year. There's no growth. To get the present value of the $12 in perpetuity, what would I need to discount it by? The 10%. You divide 12 by 0.1, you get $120. You're willing to pay $120 for a company whose assets are all publicly traded, but you're willing to pay $20. Sounds like a mystery, right? Why would anybody do it? You're doing it because Omaha Oracle is running the fund. Would it make a difference to you that the guy is 88 years old? Forever is a long time. At 88, for you, there's no forever. It is counted in days, maybe weeks, perhaps years. I don't want to be morbid, but it's reality. Do you see what's going to happen to your premium if you think he's going to be around for only 5 more years, 2 more years, 1 more year, 16 days, 2 days, 1 day, 0 days? Scary thought, but today we're going to look at Berkshire Hathaway. Because in a sense, it is an insurance company with a closed-end fund. Geico is the insurance company. And usually insurance companies get capital to invest because you put your premiums into your Geico auto insurance, house insurance, that goes in. That capital has been used to run this closed-end fund, and the manager for most of the last 4 decades, at least the lead manager, is Warren Buffett. We're going to look at the premium over book value, because book value for Berkshire Hathaway is not a conventional accounting book value. Everything is marked to market, right? So essentially it's very much like $100 worth of stocks. How much of a premium? And you can already see what's going to have happened to that premium over the last 20 years. Second question. Let's say company A owns 60% of company B and the financial statements are consolidated. I'm going to test you on how much of your accounting you held on to. Most of it you don't have to hold on to. It's not worth it. But some of it you have to, because the raw data you get is in accounting terms. If these financial statements are consolidated, if you value the company based on the consolidated financials, and for this you have to remember what consolidated means, how much of company B's value will you reflect in your consolidated value? So you have company A owns 60% of company B, the financial statements are consolidated. You do everything with those consolidated numbers, consolidated operating income, consolidated capex, consolidated depreciation, consolidated cash flow. How much of company B will you end up counting in your valuation? You'll end up counting 100%. Is that a problem? Yes, you own only 60%. So to get to the value of equity in your company, what would you need to do? You need to subtract out the 40% that doesn't belong to you. Today we're going to talk about how equity research analysts do it. They do it in a half-assed way. But this is a problem when you do valuation, especially if you have consolidation, is you've overvalued a company because you've counted 100% of a subsidiary that you're only 60% of. In contrast, let's assume company A owns 10% of company B. You use the company A financials to value the company. How much of company B is in this value? Wouldn't it be nice if it were 10%? I wish it were, and here's why it's not going to happen. What do we use to get cash flows? We start with operating income, and we work down. When you own 10% of another company, how is it accounted for? It's accounted for using what's called the equity approach. What that means is you count 10% of the net income of the subsidiary, but you count it below the operating income line. That's significant because if it's below the operating income line and you started with operating income, you haven't valued any of the subsidiary yet. See, how big a deal can this be? I'm going to show you my Yahoo valuation from 2013. You're going to see how big a deal this is going to be. Because that company, basically what you saw in their operating assets was the rump of the company. The rest of the company was elsewhere. I'd have completely missed it if I'd just taken free cash flow of the firm and discounted the cost of capital. So we're going to talk about cross-holdings, which I describe as the black hole of valuation, because this is where good sense goes to disappear, and why it's so difficult to deal with cross-holdings. And thirdly, let's assume you valued equity in a firm at $1 billion. You discount free cash flow to equity, the cost of equity. You have 100 million shares outstanding. This is not a trick question. You have $1 billion in equity, 100 million shares. What's the value of equity per share? I told you it wasn't a trick, so don't look for it. $10 per share, right? Let's assume this company now gives 10 million options to its CEO, but those options are at the money options. You know, basically the stock price is set equal to the strike price. Now, my question is only one of direction. The value of equity you had was $10 per share before they granted this option. Will the value of equity now be lower, higher, or unchanged after this grant? Is everybody agree it will be lower? Why? Because you get, but for a long time accountants told us that there was no effect on your value. On what basis? What's the exercise value of the option today? Stock price is equal to strike price, so they said exercise value is 0, so the option value is 0. One of the most absurd arguments you can make, because you try to go to the CBOE and refuse to pay a premium for an at-the-money option. How many options are you going to ever be able to buy? None. You have an option, there is a time premium. You're ignoring it. Of course you're going to find that options don't matter. We're going to talk about the history of how accountants have dealt with employee options, how that accounting created an option problem, how that option problem is fixed in accounting, and how it's playing out and how companies compensate employees today. You're seeing it in the Lyft financial statements. They had about $1 billion in losses, but they also have all these, almost all of their expenses last year, do you know that, were paid for with stock-based compensation. They paid everybody. They must have paid the janitor, the cleaner, everybody. You know, why? Because they have no cash. This is no secret as to why they do it. It's nothing to do with alignment of interest. It's you have no money. You got to pay with the only thing you have a value, which is a piece of your company. So today we're going to talk about all of those things. So let me start with a few loose ends on DCF. That's not it. That's not it. Sorry. Somehow I'd opened that page and left it, but now it's gone. Okay, while that opens. So basically, let's say assume at this moment you've kept up with the class. So let's see what you have. You have a discount rate for your company in whatever currency you pick, with a beta and a risk-free rate and a risk premium. You come up with a growth rate for your company by looking at historical growth or analyst estimates of growth or fundamental growth. What the hell is going on here? That's not good. Okay, there you go. Okay, there we go. So at this stage you have cash flows, you have a growth rate, you have a discount rate, you even know how to do the terminal value. And you're now facing a choice. And this is a real choice you're going to face in the next couple of weeks when you decide to value your company. There are all these different ways you can do valuation. You can value equity, you can value the firm. You can use 3-stage models, 2-stage models, 1-stage models. You can use the cost of equity or cost of capital. It's like you have 4 Lego boxes in front of you full of choices. You're saying, what do I pick? So let's complete that thought. Let's think about how you decide which of these to pick. So let's start with the cash flow. Which cash flow am I going to discount? I'm going to start with, should I discount dividends? Should I discount free cash flow to equity or free cash flow to the firm? Which discount rate should I use on those cash flows? And what growth pattern should I pick? So in the most general terms, you can either value just the equity in a firm or value the firm. And if you remember what I said up front, what should you get as your value of equity if you do it right? You should get exactly the same value no matter what you pay. So don't ask me which is the right one to do. You could do it right both ways. The question becomes which is going to be easier for your company. If you have a company with a stable debt ratio, stable in what sense? They've decided from this day on they're going to use a constant debt ratio to fund things. I'm going to make an argument that perhaps you can get away using free cash flow to equity because it's easy to compute. Remember that shortcut I gave you for the free cash flow to equity? Where I took a net income and subtracted out 80% of your net capex, saying that's what you always use from equity. So if you have stable leverage, perhaps you'll use equity valuation. If you're uncertain about leverage, that could go up, you just don't know, then you're probably better off valuing the entire firm. You're saying, when would I use dividends? When you get desperate. You use dividends when you really can't estimate cash flow at equity. If you're asking, when would I not be able to estimate cash flow at equity, what do I need to get to cash flow at equity? I need to start with earnings, and I need to subtract out net capex and change in working capital, right? So you take your firm, you start leafing through the financial statements looking for capex, depreciation, working capital. For most companies, you should be able to find it, right? Sometimes you might have to bring R&D in and acquisitions in, but there is a base. But let's say you're valuing a bank, an investment bank, an insurance company. You're going to find no capex. Why? Because what capex do they have? There's going to be nothing to depreciate. You say, okay, that's all working capital, right? What's the definition of working capital? Current assets minus current liabilities, or non-cash current assets minus non. Try estimating working capital for a bank. It's almost impossible to do. So for as long as people have been doing valuation, they've got to this stage in banks, they say, I can't find net capex, I don't know what the working capital is. Therefore, I can't compute cash flows. And it's not just most people. I include, until 2008, that's the rationale I would use. I'd say, since I cannot estimate cash flows, I'm going to just discount dividends. So when you use the dividend discount model in your company, it's a sign of desperation. If that's what you're going to use for your company, you better tell me why you went to dividends in the first place if it's a non-financial service company. Maybe with a financial service company it's okay, but non-financial service companies, you definitely should not use dividends. If you decide to go free cash flow, as I said, leverage is your defining variable. If leverage is stable, your company's been around 25% for the last 20 years. Lots of utilities have this feature. They have a debt ratio that's pretty stable. You can use a free cash flow to equity model. Otherwise, value the firm. If at all you feel uncertain, value the entire firm. So valuing equity is going to be more the exception than the rule because it requires so many stringent assumptions about how the company will fund its future investments. Now, once you pick cash flows, though, dividends or free cash flow to equity or free cash flow to your cost of capital or your discount rate picks itself, right? Because if your cash flows are cash flows to equity, your discount rate has to be the cost of equity, and by now we know that mantra. And if your cash flows are pre-debt cash flows, free cash flows of the firm, they have to be cost of capital. So you really don't have a choice. Once you pick that the cash flow Lego piece, the only piece that goes with it is the appropriate discount rate. And the other things also reflect, if your cash flows are all in US dollars, your discount rate has to be in US dollars. If they're in real terms, the discount rate has to be in real terms. Just be consistent. You tell me how you estimate cash flows, your discount rate in a sense has to be done in exactly the same way. So think about that for your company. You have that choice. You don't have to value a Brazilian company nominal reals. You can do it in dollars, but if you decide to do it in dollars, stay consistent all the way through. If you have a high inflation currency and you don't want to deal with inflation directly in that currency, and you want to do things in real terms, I'm okay with that as well. Just make sure you do everything in real terms. This is more an issue of consistency than what's right. You get the same answer every conceivable way as long as you stay consistent. Final piece, you got your cash flow, you got a discount rate, saying what growth pattern should I use? This is common sense, right? When can you put your company into stable growth? When it grows at a rate less than or equal to the economy. If you're valuing Kraft Heinz, when will that be? 2015. That's in your back. It's in your rear view mirror. It's already a mature company. I could have actually valued Kraft Heinz with a stable growth model today. I'd have got exactly the same values, putting that front of 10 years of cash flow. Really, I did nothing with that projection. If your company is already growing at a rate less than or equal to the growth rate of the economy, your valuation is going to come to three numbers: cash flow next year, R minus G. The one thing you should have to watch out for is that it has to have all the characteristics of a mature company. Like what? Your cost of capital should be pretty close to 8%. That's a cost of capital for a mature company. You shouldn't be reinvesting 120% because then the company thinks it has growth, it's going to destroy your valuation. So it's got to have a reinvestment rate, a return on capital, a cost of capital. So take a look at your company. You might have just gotten lucky, at least from the perspective of getting your valuation done quickly. You could do it in 12 minutes, 10 minutes, three numbers, you could do it. So if your company is already a stable growth company, don't go looking for trouble. If your company is a larger company, it's growing at a rate higher than the growth rate of the economy, or the risk-free rate, which is our proxy, then you have to coax it back to stable growth. Don't wait too long. If it's already a large company in a market that's not that large, this isn't going to last very long. So this is a classic two-stage model where you have an initial period of 4, 5, 6% growth, and then you drop it down to 2% and you're done. So if you're valuing Coca-Cola, this might be what you decide to do. There's some growth left, but not too much. You're valuing Ambev, some growth left, not too much. And then you get to the third scenario. You have a company, NVIDIA, growing at 20% a year with or without Bitcoin. Okay? You can't let it grow for 5 years at 20 and drop it to 2. That makes no sense. You don't go from 20 to 2 in one step. That's when you introduce a transition period, a fancy way of saying, I don't want to get from 20 to 2 overnight. I'm going to let it happen over 2, 3, 4 years. It's a three-stage model. But more generally, you can have an end-stage model, right? You can start at 20, go to... There's nothing that requires things happen in stages. So when you think about growth, the question you're asking is, how long will that growth last? And when you answer that question, I want you to remember what we talked about in the context of growth last session. What did I say drives the value of growth? Not how much you grow, but what is it determined by? What you earn as a return on capital relative to your cost of capital, right? The excess return. Every word has a story attached to it. So when you tell me your company has an excess return, you know what you're also telling me? Go back to Econ 101. Remember we start with perfect product markets? In perfect product markets, there's complete competition. Nobody can... In perfect product markets, you know what every company will earn as a return on capital? It'll earn its cost of capital. Because if you earn even a little bit more, competition will come in and drive it out. So when you tell me your company will earn more than its cost of capital, you're implicitly telling me that your company has some kind of comparative advantage. So I'm going to ask you, what's that comparative advantage? You say, I don't know. Then we have a problem. Because you asked me to buy into a valuation where I don't know is driving excess returns for the next 5 years. Is that I don't know a big barrier, small barrier, middle barrier? This is where having a story behind those excess returns will help you. So if your company has significant competitive advantages, give it a longer growth period because growth will have value. If it doesn't have any excess returns, it probably doesn't matter whether you give them 3 years of growth or 5 years of growth. So use that template for your company because obviously where your company will fall will depend on all those characteristics. So ultimately, when you look at discounted cash flow models, it looks like there are dozens and dozens and dozens of models. Sanford Bernstein at one time patented a two-stage dividend discount model. I thought it was the most ridiculous thing ever. A two-stage, what's so unique, what's so proprietary about this? But they went to the patent, they actually got the patent on a two-stage dividend discount model. There's nothing patentable here, because all you're doing is connecting cash flows, growth rates, and a discount rate to come up with a discounted cash flow model. I can come up with any number of different choices here, but the key I have to remember is you have to be consistent. So any questions on that part of the process? So try to do that, because as I said, that's, why am I missing slides here? Does it look like I'm skipping a slide? I have no idea what's going on. Let's see if I go to 216, then I'm in real trouble. Okay, wanted it to, for some reason decided to take 213 out. Not a big deal, it's a cover slide. So, but are there any questions on the mechanics? Yeah. Well, you got to be consistent with what you do with the growth rate. So let me take a question is, what do we do with capex and depreciation and working capital in a two-stage model? Let's take a two-stage model. In the first stage, what kind of growth are you giving your company? 5%. I'll have to reinvest enough to sustain the 5%. You say, how do I know how much is enough? Let's say you have a 15% return on capital. With a 5% growth rate, how much will you have to reinvest in the first 5 years? About a third of your cash flows, 5 divided by 15. After year 5, you go to a 3% growth rate. What will your reinvestment rate have to be after year 5? It has to be 20%. That is the advantage of linking your growth. You're no longer sitting there. So don't even think about reinvesting or think about projecting capex, depreciation, working capital separately, because that's going to get you into trouble. Think about your consolidated reinvestment. And that's going to give you at least a template for thinking about what should that number on a consolidated basis be as my growth rate changes. So the next phase of what I want to talk about is what I call my loose ends section. You know what the loose ends are? It's everything you do after you tell me you're done in valuation, because some really bad things happen after you tell me you're done. I'm going to give you the birthplace for this part of the session. You know how academia works? You probably don't. I work incredibly hard. I have to teach like 4.5 hours a week, sometimes 6 hours a week. Like this. Yeah. I get only 4 months off every summer. I don't know why it's so short. And because I work so incredibly hard, every 7th year I get the whole year off with pay. I'm sure all of you have jobs that will have something like this. It's called a sabbatical. 7th year, it's very biblical. It's like on the 7th day God rests, on the 7th day I'm supposed to rest. So in my 32 years I've had a series of sabbaticals. I've actually had 2 less sabbaticals than I should have, because I forgot to count for the first 16 years or so. My wife keeps reminding me, you forgot your sabbatical? How can you do that? Then I started remembering my sabbatical more carefully. So it was about 2007, I finally decided to take a sabbatical. And usually people have big plans for their sabbatical. They're going to write books, they're going to work, they're doing research. I had a singular objective. I said, this year I'm going to do absolutely nothing. I wanted to wake up every day with a to-do list with nothing to do. And I must confess, I got a little ostentatious about this. I went to Staples and I got one of those little to-do pads. I stayed at home, I put it above where I usually sit, with nothing on it. And my kids came down to go to school, and I pointed to my to-do and said, look kids, I have nothing to do today. Pissed them off no end, they went off to school. And then I made my fatal error. My wife came down the stairs and I said, hon, I have nothing to do today. She said, really? Why don't you take the dog for a walk? I took the dog for a walk, I come back, there's something on my to-do list. I said, what the heck is this? My plan's ruined on day 1. It says pick up bok choy at the grocery store. I didn't even know what bok choy was. Was it in the seafood section, the meat? It turns out to be ugly looking cabbage. But it took me like 2 hours to find it. I find it, I bring back home. Second item on my to-do, pick up kids from school. Item after item starts popping up. And after about the 4th or 5th item, I said, this has to stop. I have to find things to do to keep my wife off my list. So I get desperate for things to do. And then I get an email from the editor of CFA magazine. I didn't even know there was a magazine called the CFA magazine. I definitely did not know this guy. He said, can you write a 1-page article for the CFA magazine? My first reaction was, it's my sabbatical, I'm going to do nothing. But then I did remember I needed things to do. I said, yes. And then I put in big letters on the to-do list. Write one-page article for CFA magazine, cannot pick up bok choy kids, etc., etc., etc. And I did write that article, and I have to tell you, it's the only thing I've ever written in my life that's got me hate mail. You know how difficult it is to get hate mail in valuation? People don't feel strongly enough. They don't say, I hate you for using implied premiums. I hate you for using... It's not intense enough. But this actually got me hate mail for multiple reasons. One was the title. I said, stop the garnishing. I was talking about the process in valuation where people said they were done, and then they started adding things, 20% for control. Knock off 30% for liquidity. Add 30% for this. I said, you got to stop this, because if you don't stop it, you're going to go back to a number you wanted to see. It defeats the whole point. And I might have used the word arbitrary to describe these premiums and discounts, which I think some people did not like. So I get a wave of hate mail. I actually had to create a smart mailbox for hate mail. But you know how you create smart mailboxes in a Mac? You look for bad words and say, do you find any of these words in the just put it in the... So I did a pretty good job. You know, lots of hate mail goes direct. I just deleted the whole mailbox when I was done. But one of the emails I got in response did slip through. And here's what it said. If you think what we're doing, and usually these were private company valuations, because a lot of these appraisers who use premiums and discounts, they're not restricted, but mostly that. Said, if you think what we're doing in private company valuation is so arbitrary, why don't you come up with a better way of doing it? He said, that's fair. He said, I have 11 months left in my sabbatical, and my wife is desperate to get to my to-do list. So here's what I'm going to do. Every month, I'm going to pick a loose end, and I'm going to spend the entire month thinking about it. This is how you can waste your time on sabbaticals. So here's what I did the first month. I picked control, and I said, if I were valuing control from scratch, how would I do it? Next month I picked liquidity. If I were worried about liquidity, how would I price it out? Third month I picked complexity. If I had a complex company and I'm worried, so each month I picked a different loose end. And what you're going to get is a compressed version of those 11 months of my life. It's actually one half of one of my valuation books now. So let's start with the first item. I'm going to go back to something I thought we'd settled. What do we say you should do with cash? If you have cash in your company, how should we value? I said, don't mess with it, right? $100 in cash is worth $100. I'm going to reopen that box. I'm going to ask a question. Is it conceivable that there are some companies which have $100 of your cash where you value the $100 at less than $100? You discount the cash in the hands of some companies. Is it also conceivable that in some companies that $100 in cash has a premium attached to it? Think about it for a moment, because I'm going to present you with a scenario where you might actually start to do that, and then I'm going to ask you, why do we do that? Second, I want to talk about cross-holdings. In a perfect world, how would you value cross-holdings? In the world we live in, how would you value cross-holdings? And the two are very different. Third, I want to talk about mopping up. You finish your DCF valuation, you bring in cash and cross-holdings, you look around and say, is there anything else I should be adding on? And you're going to be tempted. You're going to look at the balance sheet and say, hey, they own real estate in New York. That's worth $1 billion. I should be adding that on. What should you be adding on and what should you not be adding on? It's a big question in mopping up, so I want to mop up. Then I want to deal with the issue of complexity. As you value a company, some of your companies are pissing you off no end, right? Like when they break down their revenues, why don't they just tell you where they sell stuff instead of hiding it behind these rest of the world or Eurasia, whatever that means, Where is Eurasia? I don't know. It's somewhere there in the middle between Europe and Asia, I guess. Okay? Why can't they just be direct and tell you where they get their revenues? Have you noticed this as you read your annual report? Why aren't they more direct? And some companies are clearly designed to make things difficult for you. And you want to punish these companies. I'm going to give you a way to take your frustration out. See, you really pissed me off. I'm going to knock 15% off. It'll make you feel a lot better about the valuation when you're done. For all the time you spent. Complexity. Then I want to talk about debt. We talked a lot about debt, right? We've talked about debt in the context of cost of capital. It's a weighting mechanism. We now have to talk about debt as something you subtract out to get a value of equity. And I'm going to argue that the way you define debt might be different in the two places and talk about why. And then I want to close with employee stock, because there's a huge amount of confusion about stock-based compensation. How you deal with it in cash flows, how you value it, etc. So let's set the show on the road. Let's talk about the value of cash. The simple rule with cash is the easiest of all assets to value. It's invested in T-bills and commercial paper, earns a low rate of return but a fair rate of return, so cash is cash. But cash can get mangled in lots of different ways. When you use any equity-based approach, free cash or equity or dividends, remember those start with net income, right? And remember, net income includes both net income from operating assets and net income from cash. So if you're not careful, you do an equity valuation, cash is in there, but in a very strange way. It was part of your cash flows, but you were discounting at the cost of equity. So even if you're aware of the things around cash, if you're not careful, cash is getting discounted for all the wrong reasons. But I want to frame it slightly differently. I'm going to show you 3 different companies, all of which have exactly the same cash balance. And I want you to think like investors in these 3 companies. So each of these companies is $1 billion in enterprise value and $100 million in cash. The cash is there. There's no question about the cash being there. But here's where they're different. Company A has a history of earning a return on capital. This is not about future return capital. They're past. That's all you know. Their history is they've earned a return on capital roughly equal to their cost of capital, developed market company. Company B has a history of having earned a return on capital well below the cost of capital, also a developed market company. And company C is an Argentine company that earns 10% more than its cost of capital. There's a reason I made an Argentine company. You're going to see why. I'm going to argue that even though all 3 companies have $100 million in cash, in one of these 3 companies, cash is going to be a neutral asset. What does that mean? You're going to value 100 at 100. In one of these 3 companies, you might attach a discount to the cash, and if you say yes to that, I want you to tell me why. And in one of these 3 companies, you'll attach a premium to the cash, and again, if you say yes, I'd like to know why. Let's start easy. In which of these 3 companies is cash most likely to be a neutral asset? And what is it about A that makes it such? It's a block company. You know what block companies do? They don't hurt you, they don't help you, they just run in place. They're not doing any damage, but they're not creating any value. So company A, cash is a neutral asset. In which of these 3 companies are you most likely to discount the cash? I heard a C, and how many of you say B? And what is it about B that scares you? Their history, right? What's their history? They've shown the capacity to be really stupid in the past, and you're afraid they haven't stopped now. You're attaching a stupidity discount. You're saying these guys are so stupid, they will find a way to the $100 in cash is not hurting you, but what they do with the $100 in cash could hurt you. Cash by itself has never hurt an investor. It's what companies can do with the cash that's good scary. I should have made company C be part of the world where people don't have strong views. I was doing this in Brazil. I present this to my group, and they ask them, which of these 3 companies would you discount the cash? To a person, the entire group picked company C. And I said, why? I said, Argentines, you can never trust them. This is what happens when you have, they'd lost a soccer game maybe in the previous week. They were really pissed off. But there is an argument that in company C, you might actually attach a premium. And here's why I made an Argentine company. Argentina has had 5 crisis episodes in the last 20 years where everything shuts down. Equity markets are shut down. Banks have stopped lending. Do you see the advantage of having cash when capital markets are completely shut down? What does that cash allow you to do? It allows you to survive first, and then it becomes a strategic weapon because other people are so desperate for cash, you can actually buy assets at a fraction of their value. You know why in traditional corporate finance no company ever needs cash? What do we assume companies are able to do? If you have a great project, what do I assume you can do in conventional corporate finance? You go to market, you raise the capital. What's the problem? The problem is you're in Argentina. What market are you going to go to, especially if it's shut? And you don't have to be Argentine to have a capital constraint, right? You're a small company in the US. You're a high-tech company and VC capital dries up. There are lots of different ways capital constraints can kick in. And if those capital constraints kick in, it's nice to have a large cash balance. So it sounds almost outlandish that you'd be attaching a discounted premium, but let's be very clear as to why you're discounting the cash. It's not for the stupid reasons that you sometimes read, which is cash earns a low rate of return. Of course it earns a low rate of return, but that's okay. It's because that cash is now being invested in projects or in acquisitions just because you want to get rid of the cash. So to show you backing for what we just did, discounts or premiums, I'm going to show you the results from a study. This is actually a very creative, one of my favorite research papers of all time. And what they did was they looked at how much investors valued $1 in cash in the hands of a company. So they looked across all US companies to see whether investors were valuing $1 in cash at about $1. And I'll give you the good news first. Across all companies, $1 in cash is valued at $1. You know why this is good news? Because this is what we always do, add the cash balance. But here's where it gets interesting. When they looked at mature companies with negative excess returns, that's companies like Company B, right? Large companies with low growth, earning less than the cost of capital, $1 in cash was valued at 69 cents. Think about that. You have a $10 billion cash balance. I act like you have a $6.9 billion cash balance. If you're the manager of this company and you want some value enhancement advice, I can give you some very simple advice. You want to unlock $3.1 billion in value, what should you do? Give the cash back. You know how resistant managers are to that very simple notion? Give the cash back. No, 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 no. I can't do that. This is exactly why activist investors are able to get rich. Carl Icahn is not the deepest corporate finance thinker in the world. He's a one-trick pony. What does he do? He goes to companies, you have too much cash, give me the cash. If you notice, it's pretty much every Icahn pitch, you have too much cash, give me the cash. Sounds, why does this guy get worth so much? Well, how is he worth billions? Because he picks the right companies. You pick companies like Company B, you go to the company and say, you got too much cash, give me the cash. Overnight, you don't have to fix projects or do operations better. You're just releasing cash from the hands of companies where investors have lost trust in the company. And there are lots and lots of companies where this is true now. Across the world, mature companies well past their sell-by due date that continue to exist with big cash balances, giving the cash back can unlock the value very quickly. And at the other end, you have high growth firms which earn well above the cost of capital, usually smaller companies where $1 in cash can be worth $1.22. Why? Because these are the companies which face capital constraints. I was looking across the ride-sharing companies. You know what the smartest things that Didi did last year? They raised $12 billion in cash and they held on to it. Why? They're a cash-burning machine. And they know if venture capital money stops coming in, the game is over for them. And they've essentially at least bought themselves about 2 to 3 years of life without having to go back to capital markets. I think that makes them stronger than Grab or Uber. Uber is about 12, so it's not too bad. But Lyft is down to what, 500 million? Maybe that's the reason they have to go public. You have no choice, right? You really need the capital. So don't dump on small companies that have big cash balance, because sometimes that might be what allows them to survive and become going concerns. Yes? I don't care. You pay a special dividend. Just get the cash out of your hands. If necessary, create a trust and say, I'm going to give it to this guy. I'm not going to be allowed. Because that's what scares me. Is you touch the cash, you could screw it up. Just make sure you can't touch the cash. Right? Anything to get U.S. managers away from the cash makes me feel more secure. So it could be dividends, it could be buybacks. No, it's just going to be a lockbox. And put the cash in the lockbox. We can never touch it. No. Something to keep you from doing bad things with the cash. Yeah.
Put that cash in the lockbox, valuation, we need some kind of discount or premium.
Yeah. The question is, how do I get the premium for Warren Buffett's closed-end fund? In fact, let's talk about closed-end funds. You're going to get a very simple way in which you can attach a discount or premium. It's going to be based on what kind of returns you can make on your projects. So now let's use that cash discussion to talk about closed-end funds. I already described what a closed-end fund is. And one of the interesting things, and this was called the closed-end fund puzzle when it was first discovered in academia, is when people first looked at closed-end funds, they expected closed-end funds to trade at roughly book value, net asset value. Why? Because the assets are all marketable, you can see the market prices, and the argument was you can't really trade at a price different, especially you can't trade at a price lower, and you're going to see in a minute why that was considered a non-starter. But they found that on average, closed-end funds have a discount of between 15 to 20%. That's still true. Across the world, closed-end funds trade at a discount on average of 15 to 20%. Doesn't mean every fund is discounted, but the median discount is 15 to 20%. And that was called a puzzle. So why does it happen? And the reason for that is very simple. There was an arbitrage opportunity, right? And we're using the word arbitrage the way it's meant to be, which is riskless, clear cash return. So what was the opportunity here? You have a closed-end fund where all its assets are marketable securities. It's trading at less than the value of those marketable securities. So carry through the rest of the arbitrage rule. So what am I going to do? I'm going to buy the entire fund at 85% of the, then sell the stocks and claim the 15% difference. And of course, there are frictions in this process. You've got capital gains you might have to pay on some of those stocks. Some of these funds are set up in the Cayman Islands or someplace where getting to them is so difficult. But if you took, say this, you shouldn't have a discount. But let's step back. Let's assume that the immediate liquidation is not an option. Let's think about why there's a closed-end fund puzzle. Yesterday I was at Fidelity. Active money manager, huge one, right? So tell me on average how much active money managers beat the market by every year. I wish it was zero. So the transaction cost is about -1 to 1.5%. So let's assume that the typical closed-end fund manager, let's be good to this guy. Let's say underperforms the market by 0.5%. And you know this is going to happen in the long term. Do you see how this is going to translate into a discount? When you invest $100 in this fund and you need to make 11.5%, and I deliver only $11 a year, think of the same way we valued that closed-end fund run by the Omaha Oracle. If I make $11 a year and have 11.5% required rate of return, what I'm going to get as a present value is about $96. What does that mean? I'm going to have a 4% discount on my $100 face value. If you underperform by 1%, the discount is going to get about 9%. If I underperform by 2%, so basically the discounts are going to reflect expectations that you can beat the market. And of course, if you're a closed-end fund that can do better than the market, at least on an expected basis, it could trade at a premium. So there's your Berkshire Hathaway graph. I should probably update it through 2018. But here's the short story. Basically, the book value for Berkshire Hathaway are all the publicly traded stocks they own. Right? Coca-Cola, Washington Post, you can go through the list. The price is what you're paying for Berkshire Hathaway. At its peak in the late 1990s, Berkshire Hathaway traded about 2 to 2.5 times book value. Think about it. If Coca-Cola trades at $40 per share, when you buy Berkshire Hathaway, you are effectively paying $80 to $100 per share for the stock. But you're doing it why? Because you have the greatest fund manager in history running your money. So you're saying, I'm not paying more for Coca-Cola, I'm paying for more companies like Coca-Cola in the future. So in the late 90s, Berkshire Hathaway's premium is 2 to 2.5%. And over the last 18 years, that premium has decreased. You have ups and downs, but the trend line is down. And people say, well, is this a buying opportunity? And the answer I gave you at the start was the fact that in the late 90s, Warren Buffett was still in his sprightly late 60s. Now he's in his sprightly late 80s. But one of these days he won't be as sprightly, whatever, right? 98 or 108 or whatever you think his extended life is going to be. Mortality is something you can't avoid. You could be the greatest investor on the face of the earth. Guess what? You are going to die. Right? I mean, this is not secret, so don't review. I don't know anything. It's not sick. It's none of that sort. But as you get older, it is going to start to show up in the remaining life you lead. And you add 2 additional complications. Those excess returns that Warren Buffett earned were far greater in the 60s and the 70s than they were in the 80s, and far greater in the 80s than they were in the 90s. And over the last 20 years, he's been a pretty average investor. The stocks he's picked for Berkshire Hathaway have been pretty close to the S&P 500 in terms of the returns. So there's the aging process. No. What about Combs and Wexler? Nice guys, but let's face it, you're not paying a premium for Combs and Wexler managing your money. They might be nice guys, but these guys are not going to be able to deliver excess returns simply because they're just nice mutual fund managers. So what does this mean? You're going to see Berkshire Hathaway behave more like an insurance holding company. For a long time, it's been dealt with as something special, but the best way to get perspective on what's happening at Berkshire Hathaway is to think in terms of this expected premium and the fact that Warren Buffett might not be your fund manager for much longer. He's actually not been your fund manager for about 5 years already. People don't seem to realize it. He's no longer the person supposedly making the investment decisions. I don't know how true that is, because he's passed that responsibility on. But you're seeing that reflected in that premium. Any questions? Anybody here own Berkshire Hathaway stock? Yep. You don't own Berkshire Hathaway stock, right? Because then you're taking everybody out for dinner because they're like $250,000 stocks. Huh? We know you're rich then. So, but go ahead. Yeah, you have See's Candy. They're a very small. If you look at their total portfolio, though, they're true. It's true. They own businesses. They own See's Candy, right? As a fraction of the value, those private businesses are still a very small piece of the puzzle, right? Yeah, but I'm saying they're a small piece of the bigger puzzle. The fact that they're not marked to market will mean that your price to book will never drop to 1. It'll still stay above. But the fact that there's a trend line means that you are getting a premium on the Coca-Colas of the world, not on the See's Candy. Nobody bought Berkshire Hathaway saying, oh, See's Candy is going to make me rich. It's too small a piece of the company. So unfortunately, Berkshire Hathaway's value comes primarily from the publicly traded stocks. So that's why last week was a bad week for Berkshire Hathaway. Kraft Heinz drops by 25%. Berkshire Hathaway feels the pain because they own so much. That would have probably wiped out 4 of their businesses, that small private business, in one day, right, in terms of total value. And that's why I think ultimately this premium was never for you buying See's Candy. It's for your stock picking that I was paying. And that stock picking, the clock is running. It's going to run out sooner rather than later. Right? Let's talk about cross holdings. The biggest challenge in cross holdings is learning how accountants actually show them. Cross holdings can broadly be categorized into 3 groups. You can have minority passive investments, minority active investments, and majority investments. Let's start with minority passive investments. Very uncommon, but here's how it will work. You own 5% of a company. You take no role in how the company is run. You thread enough of those loopholes that you have to thread. You get classified as a minority passive investment. Here's what you have to show in your income statement. You have to show the dividends you receive from that holding in your income statement, only the dividends. And in your balance sheet, you have to show what you originally invested to get that cross holding. To show you how disconnected this can get from reality, let's talk about SoftBank. SoftBank is a Japanese VC firm. And in the late 90s, 70% of SoftBank's value came from one holding it had in Yahoo. It was an early venture capital investor in Yahoo. That value had soared because Yahoo had become a $100 billion company. 70% of SoftBank's value came from Yahoo. But it was classified as a minority passive investment. So let's take a look at the income statement for SoftBank. What would you have seen on it? The dividends they received from the Yahoo holding, right? In the late 90s, you know what that was? Yahoo was paying no dividends. There'd been no dividends. You say, okay, let's look at the balance sheet. And in the balance sheet, you'd have seen a $50 million value for their Yahoo investment because that's what they originally invested as VCs, even though it was worth $7 billion. You can see how quickly you can lose connection with what the value of your holding is if all you do is look at the income statement and the balance sheet. That's minority passive. Thank God it's uncommon. Let's move one step up the ladder. You own 20% of another company. You take some role. It's a subjective judgment, but some role in the company. You classify it as a minority active investment. Here's what you have to then show. In your income statement, you have to show 20% of the net income or net loss you receive on this holding below the operating income line. That's key. And in your balance sheet, you have to show what you originally invested plus 20% of the retained earnings since. It's like an updated book value. Little better than minority passive. And then you get to majority holdings and accountants flip out. You own 60% of a company. What are you required to do? Act like you know 100%. I've never understood the logic for this. So here's how it works. When you do your cash flow, you need to do your income statement. You're told to count 100% of the revenues. And you complain. I own only 60%. The accountant says, don't worry about it. So you don't. You get operating income. You count 100% of the operating income. You say, I own only 60%. Don't worry about it. You get to the balance sheet. You count 100% of the cash. I own only 60%. Don't worry about it. Then last moment the accountant wakes up and says, worry about it, you own it 60%. So that's what I've been trying to tell you all this time. You don't own 40%? Yeah. We have to do something about it. So what does the accountant do to reflect the 40% that doesn't belong to you? If you look at the liability side of the balance sheet, you'll see either minority interest or non-controlling interest. And the minute you see it, you know your pain threshold just went up. Because in your valuation, you have consolidation. Whether they tell you or not, if you see minority interest or non-controlling interest on the liability side of the balance sheet, it means things have been consolidated for a company that you own less than 100% on. So let's set up a very simple exercise to see how we'd approach this evaluation. Let's say you take a company, you take free cash flow of the firm and cost of capital, you discount it all back, you come up with a value, a present value of $1 billion. You have debt of $200 million. How much is the equity worth? If I stop right, that was the entire problem on your quest. The value of your equity is $800 million, right? Somebody keep tabs on this number, because now I'm going to start throwing everything but the kitchen sink at you. Now I tell you, you know what? I forgot something. This company owns 10% of company B. That company is publicly traded, and the market cap of company B is $500 million. So remember, we stopped at $800 million? So here's the question I have for you. I've now thrown this additional piece of information at you. Will or should your value change? Is it already in your income though? What did I call it? 10% of another company, we use the equity approach. We use the equity approach. Where does the income show up? Below the operating income line. If you start free cash flow at the operating income, which is what you usually do, you haven't counted the 10%. So should I add the 50 million, subtract the 50 million, ignore the 50 million? Okay, so somebody keep tabs. They're up at 850 million, right? 10%. Then I say, oh, by the way, company A owns 60% of company B, and I forgot to mention that as well. Lots of things I forgot to mention. And I say the minority interest that the accountant shows in the balance sheet is 40 million. Again, what does minority interest reflect? It reflects the accountant's estimate of the 40% that doesn't belong to you. We made a bunch of flawed steps here. We'll come back and fix them. But if I stayed with these flawed numbers, I was at 850, right? Now what do I do with the 40 million? Add, subtract, or ignore? I'm going to subtract, and why? Because when I did my valuation, I used free cash flow of the firm that acted like I owned 100%, and now I've got to subtract out the 40%. But here are the flaws in what I did. The first step was a true intrinsic valuation, right? Cash flows discounted the cost of capital. In the second step, what did I take as my value of company B? I took the market cap. I said, you know what, too much work. The third step, to get a value of the minority interest, what did I use? Book value. This is a complete and total mishmash, but this is the state of the art in valuation. This is how most people deal with minority holdings and majority holdings, is by mixing them up. So if you were in a intrinsic value world and you want to stay in an intrinsic value world, you know what you'd have to do, right? To value company A then, what did I have to do? I'd have to do full intrinsic valuations of company B and company C. And let's say I did that. Let's say the intrinsic value of company B is 250 million, the intrinsic value of company C is also 250 million. Remember we started with 800 million? Where would I end up if I gave you the intrinsic value? I own 10% of company B, right? And if the intrinsic value of equity in company B is 250 million, 10% of 250 is 25 million. So I'm going to add 25. How much of company C do I not own? 40%. 40% of 250 is 100, so you have 800 plus 25 minus 100 is 725 million. Much lower than I got with my mishmash. But if I stayed in an intrinsic value world, this is what I would need to do. You see, what a pain in the neck. Sometimes sometimes the holdings might be small enough that you can use the mishmash, right? If you're a $10 billion company with a holding in a $100 million company, who cares whether the market value is 150 or 50, you can go. But remember I told you that I valued Yahoo 5 years ago? I couldn't use the mishmash, and here's why. In a perfect world, if you asked me to value a company with cross holdings, first, I would never work with consolidated numbers. The reason being, when you work with consolidated numbers, let's say you're a steel company owning a chemical company. When I consolidate them, whose cost of capital do I use? Whose growth rate? It's two different stories. So if you're a company with cross holdings, what I'd prefer to do is start with your parent financials. Parent financials, you don't have any consolidation. You get the operating income for just the parent company. I'll value the parent company. Then I will value each of their cross holdings separately. And then I'm going to take your parent company value plus 10% of company B. So in other words, you're not subtracting and adding and doing all this crazy stuff, because now you've gone back to a core parent company value and you're now adding on the value of every cross holding. So here's Yahoo, my intrinsic valuation. So about 2 years after Marissa Mayer became CEO. And remember what our mission was, right? Turn Yahoo around, make it the next Apple. An impossible mission, and you're going to see why. I valued Yahoo as a standalone operating company based on its parent financials. So this is the operating income from the search engine. There's not much operating income, there's not much growth, there's not much cash flow. My value reflects it, worth about $4.3 billion in operating assets. Added the cash, subtract out the debt. If I'd stopped right there, the value of Yahoo equity would be about $7.4 billion. But here's what I was missing when I focused on the Yahoo numbers. There are two cross holdings. One was 35% of Yahoo Japan, which is actually a standalone publicly traded Japanese company. And the other is about 22% of Alibaba. This was just before their IPO. So I valued first Yahoo Japan as a publicly traded company. I had the full financials. I was able to do it. And 35% of my estimated intrinsic value of $21 billion gives me about $7.3 billion. I wasn't able to do this till 2014. You know why? Until 2014, Alibaba was a private company. It's only when they filed their prospectus for their IPO that I was able to take this third step. Because until then, the 22%, I'd have to take book value or some estimated value. But now I had the full financials. I did an intrinsic valuation of Alibaba's operating assets, and you can already see the elephant in the room, $128 billion. You add the cash, you subtract out the debt. That's about $146 billion in equity. 22% of that gives me $32 billion. My value for Yahoo, collectively, the equity, is $7.4 billion plus $7.4 billion plus $32 billion. Now do you see why Marissa Mayer never stood a chance? This is like my putting you in the outhouse and say, make sure the main house is run well. The value of Yahoo on any given day had less to do with what Marissa Mayer was doing at Yahoo than what Jack Ma was doing with Alibaba, right? In fact, in that post, at the end, I said, you know what? And this might sound cruel. I said Marissa should probably fire everybody at Yahoo. We get two big terminals. One tracks Alibaba's stock price, the other Yahoo Japan's stock price. Because that's what's going to drive the value. You can try everything you want. There's nothing you can do when 90% of your value comes from your cross holdings and you don't control the way those companies are run. This is an exceptional case. But essentially, Yahoo had become a holding company by 2014 when 90% of its value were these two holdings. But this would be a scenario where you got all the information. So you'd have to get the financials of the parent, the financials of the subsidiary, and if you can do that and you have only 3 holdings, this is clearly doable. And for some companies it's doable. But here's where it gets messy. When you're a company with multiple holdings, and some of these holdings are private and some have no information on them, you can't even, this is not even a choice. You can't do an intrinsic valuation of a subsidiary if you can't have access to the financials. I'll give you a story to back up how difficult it can be. In the late 90s, I was updating one of my valuation books, and I was valuing a Japanese company. And when you're valuing Japanese company in the late 90s, you're always teetering on the edge of disaster because the risk-free rate in yen was so much lower than the risk-free rate in any other currency that if you use growth rates you were usually using in your valuation would blow up. So I was pretty careful. I finished the valuation. I'm patting myself on the back. And I'm reading the annual report at the same time. I can do 2 things at the same time. And they mentioned they have 227 cross holdings. My task is laid out for me, right? If I were a hard-working, careful analyst, which I'm not, what should I be doing next? Doing intrinsic valuation of 227 companies. But even if I'd been a hard-working, careful analyst, I couldn't have done it because in this case, 167 of these companies were private companies and 0 information was provided about the cross-holdings. The other 60 were public companies, 160. So I remember calling the investment relations officer of this Japanese company. I said, look, I'm valuing a company. It's not for an expose. I'd like to get some information about these cross holdings. She said, I cannot give you that information. It's proprietary. The way she said proprietary was kind of scary. I said, okay, what if I bought 1,000 shares in your company and called you again? She said, still be proprietary. See, that's strange, because if I own 1,000 shares of your company, I'm part owner of your company, you're refusing to tell me what I own. She said, you have a point, but it's still proprietary. So at this point, I'm banging my head against a brick wall. I get ready to hang up the phone. She said, no, I do have something I can tell you about these cross holdings. She says, maybe she's going to give me some revenue numbers, some operating income numbers, margin numbers. So I said, what? She said, I cannot give you specifics, but I have to tell you these cross holdings are worth a lot. I said, let me be clear. In my Excel spreadsheet, do I just enter LOT in the cell? I'm getting error messages right below. How many zeros are there in a lot? But this cuts to the heart of the cross-holding culture, right? What do managers do? They hold up a brown paper. Trust me, it's full of cash. I'll tell you exactly how much is in the brown. Can I look in the bag? No. I'll tell you how much. This is exactly, and as long as you accept what the managers say, why would they ever let you look in the bag? We deserve the companies we get. And guess what? We've let these companies get away with these cross-holding numbers that they tell us what the value is. Okay, if you say so. I mean, come on, you live in New York. Somebody walks up to you with a brown paper bag full of cash and says, you should run in the other direction. Don't even wait for the question to come. Do you want this bag? It's clearly without looking in the bag. And that might be dangerous by itself. There's nothing we should be attaching as value. But all the time we do this with cross-holding companies. So I'm going to give you my approximations. For publicly traded companies, there's 60. I cheated. You know what I mean by cheating? I wasn't valuing 60 companies to value one company. They were publicly traded. There's a market price. I just used the market price. They were small relative to my parent company, so that was my excuse. For the other 167 companies that were private companies, here's what I did. I took the book value, which was in the balance sheet. I knew what businesses at least these cross holdings were in. And on my website, I maintained this table of what the price to book ratio is by sector. So let's say 167 companies in the chemical business. And the typical chemical company trades at 2 times book value. I'm going to take your book value and multiply by 2. And I do this with both minority interest and book value if I cannot estimate a value. It's not perfect. It's not even close. But with the information you have, it might be the best you can do. Now, could I have priced Yahoo? Remember early in this class I talked about value versus pricing. Let me give you a short preview of what pricing Yahoo would have looked like. When you price companies, what do? You try to find a multiple in comparables, and you price the company based on how similar companies are priced. So I said, okay, let's try a pricing exercise in Yahoo. I took Yahoo's revenues, and I applied a revenue multiple based on how online advertising companies trade, right? I came up with about $2.9 billion. Lower than my intrinsic value, but not by much. And I did the same thing. I priced Yahoo Japan, and I priced Alibaba Equity. And if you add up the pricing that I got across these companies, I'm getting a pricing value. In fact, in both these valuations, you notice there's a tax that I subtract out. You know what the tax is for? If Yahoo ever decided to get out of its Alibaba holding, it will face a capital gains tax because it invested so much less than what it would have received as proceeds. I'm estimating what that tax would be because I want to make sure that I'm counting all the costs that would come if I untangle these holdings. So when you look at cross holdings and you want to do intrinsic valuation, try to do intrinsic valuation all the way through, but you might end up doing intrinsic valuation of your parent company and pricing for your subsidiaries because that might be the best you can do. Any questions on cross holdings? Yes?
This example for Yahoo,
Yeah.
so you're saying that the intrinsic valuation gives a higher value than the pricing?
Why are you surprised? That's actually a good question. He was surprised that the intrinsic value gave a higher price than the higher number than the pricing. It can't cut in one direction, otherwise we'd have a problem. If intrinsic value always gave you a lower number than pricing, we're in deep trouble. Because we should never be doing intrinsic valuation then. Do you see why? How do you make money in intrinsic value? The price has to converge the value. So it's not true that intrinsic value always gives you a lower number. In a particular market, in specific sectors, that might be true. But there's nothing inherent about intrinsic valuation that says the value that you get has to be lower than the price. Now let's talk about mopping up. So you've done your discounted cash flow valuation, you've dealt with cash, you've dealt with cross holdings the best you can. You get ready to be done, but then you check the balance sheet, say, is there something I've missed? So you're valuing JP Morgan. How many buildings in New York City does JP Morgan have these long-term leases on? Every time I have to go to JP Morgan, I have to check where. Park Avenue, next it's downtown. It's almost like they have a shell, go to Brooklyn, they own like 10 different buildings. Maybe 2 buildings and they lease the rest. Let's say they own 2 buildings. 2 buildings in New York City are probably worth $1 billion. So let me ask you a question. When you do a valuation of JP Morgan, let's say you use dividends or free cash flow at equity, come up with the value for JP Morgan, should you be adding the value of the real estate that JP Morgan owns in New York to that value? Why? It's $2 billion worth. Why am I leaving it on the ground? Be specific. When you say I already used the asset, in what sense? There are people sitting, presumably doing things, right? There are traders in some of those buildings. The income that gave me my dividends and cash flows came from people sitting in the building. If I've discounted that cash flow back and I add the value of building, I've in a sense double counted. I'll give you the analogy. It's like owning real estate, where you take the rental income you're going to earn in the real estate and you take the present value of the rental income, and then you add the value of the real estate today to that present value. You actually counted the same stream twice. So when you talk about other assets, be very careful that you're not, so you can't count buildings. If you're an oil company, you can't count the refineries, the physical cost of the refineries and the ships you own, because that's what delivers your cash flows. So you're saying, what else is there? Definitely don't count things like goodwill, because we know it's a plug variable. But what if accountants start putting things like brand name on the balance sheet? You know what terrifies me? If they put brand name on the balance sheet, here's what's going to start happening. People are going to value companies, and then they're going to look at the brand and say, that's a $3 billion value for brand name. Let me add that to my DCF value. You cannot count an asset twice. So what you're looking for are truly vacant assets, assets that are not part of your cash flows. You're saying, what kind of asset could that be? I'll give you my favorite example. Anybody here part of the Michael Price Fund? Okay. I've actually was involved in raising money for the fund 16 years ago. I hate to raise money, so they held a gun to my head. So go to Michael Price, ask him for some money. But then I said I will never be part of how this fund is run from this day on, because it is what it is. But over the years, people have dropped in my office and tried that, because in the fund you pitch stocks to each other and convince each other that this is a great. So about 10 years ago, sitting in my office, somebody from the fund comes in. And he says, I'm facing a conundrum. I very quickly turned to my computer, looked up on a thesaurus what he was talking about. It turns out he was confused. Okay? But I liked the word. So I said, what's your conundrum? He said, I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I've come up with a value of $240 million. The stock's trading at $280 million. I said, I still don't see a conundrum. Looks like you're overvalued. Let it go. He said, my conundrum, and now we're getting to the true conundrum, was there's one big asset that Playboy owns that I haven't counted in the $240 million. You know what he was talking about? It's not the bunnies. Don't let your head go on all those. Those are all in the cash flows already. It's a mansion. The Playboy mansion is one of the most valuable pieces of real estate in LA. At the time that he came in and talked, the value was about $120 million. So you know the question he was asking. Can I add the $120 million? It's not in my cash flows to the $240. Technically, the answer is yes, but there's one small problem. There was an 80-year-old in a bathrobe hanging out in that mansion. You couldn't exactly evict him without serious public relations problem. I'm talking about Hugh Hefner. So he said, what should I do? I said, why don't you check the actuarial tables? Today is a day of morbid thoughts. He said, what am I checking for? Check to see how long 80-year-olds who surround themselves with 26-year-old playmates tend to live. This is a tremendous stress on your heart. Sooner or later, you're going to kick the bucket. Something's going to go. Hey, how about 7 years? Let's give him 7 years. Then you know what you need to do next, right? What do you need to do? Project out the value of the building or the house 7 years. Discount it. You can use a real estate cost ticket. Do whatever makes you happy. Okay? Take the present value and add it onto the $240 million. I forgot all about it. Then 3 years ago, I open up the paper and I see a news story that Playboy has actually sold the mansion with Hugh Hefner in it. I'm not kidding. The guy who bought this, a Greek billionaire, bought the mansion with Hefner in it. The condition was that Hefner would stay in the mansion till he died, and the guy paid almost $200 million for the mansion with Hefner in it. I don't know what he was thinking. I mean, knowing Hugh Hefner, he probably said, I'll live to be 115. Didn't turn out that way, but that's the risk you take. When you have a vacant asset and you assume it can be monetized, it's often not that simple. There's some friction in the process. But in Asia, this problem is kind of playing out in many ways, because as you know, in Asia, real estate values have zoomed through the roof. I mean, I know of textile plants in the middle of Mumbai, prime real estate. There are textile plants. If you take the present value of the cash flows of these companies as textile plants, are worth, let's say, 100 million. But the real estate they're sitting on is worth $500 million. So let me put that to you. You have a textile plant on which has a present value of cash flows of 100 million. You're an investor interested in investing in the plant. Which of those two numbers would you attach as a value to this plant? Well, you don't. You're an investor. You can't go around doing stuff you like to do, right? You don't control it. If you're acquiring the entire company, then you might say, look, I can sell it, so I'm going to pay as high as 450 or 480. But if you're an investor buying the shares, what's your worst case scenario? You buy it as if you're going to get the 500 million. The family that runs a textile plant is so proud of having a textile plant in the middle of prime real estate, chooses to run it as a textile plant for the rest of eternity. You're doomed, right? So what you're actually going to do is have to play this probability game, which is there are two values. My value for this plant is going to lie somewhere between these two numbers, and it's going to depend on the probability that will get acquired and the land gets sold off. It's made valuation in general across Asia hugely difficult for real estate intensive companies. Retail. Indian retail is nothing to do with retail. It's all real estate holdings. You can be a terrible retail company, but if you have prime real estate holdings, you're going to get a high value because people value you as a collection of real estate holdings. So that's something you want to keep in mind as you value companies, especially if it's a hotel company. Do not be surprised to get a DCF value much lower than the market price. It's not that the market has gone crazy, but the market is attaching that price based on the real estate under your hotel, which might be worth a lot more than your hotel as a hotel company. It's part of the reason Marriott decided to take its real estate and make it a separate company, because it found that the way it was making decisions was skewed by this real estate factor. You see how it makes? When you want to open your next hotel, if people are pricing you as a real estate company, where are you going to open your next hotel? Not where you're going to make the most hotel revenues, but based on where's the real estate going to go up the most? And Marriott decided this was a very unhealthy way to run a hotel company. They said, we're going to create a Marriott REIT that owns the real estate. They take care of the real estate part. We run the hotel company. We get a management fee. We run our company based on what's best for us as a hotel company. They make the decisions based on what's best for them in real estate. And increasingly across the world, hotel companies might have to think about doing this, because especially if you're the luxury hotels, which are in the middle of cities, really valuable land, the Waldorf Astoria, there is no way that hotel gets enough cash flows to justify the value of that building as real estate. There's absolutely no way. But you know what? As long as the people are willing to pay for that real estate and passes, you're willing to pay that price because you're paying for the real estate now. You're not paying for the hotel as a hotel company. Now let's set up another experiment. Let's suppose I come to you with two companies. They have exactly the same numbers in terms of cash flows, growth rate, cost of capital, etc. But here's where they're different. The first company is in a single business. The second company is in multiple businesses. The first company has a very simple holding structure. You can see what it owns. The second company has a very complex holding structure. The first company has transparent accounting. It tells you what it does and you can understand it. The second company has opaque accounting. What's opaque accounting? It's one of those annual reports you read and you wonder what language it's in. It claims to be in English, but you have no idea what it's saying. You read it again, you get even more confused. It's written in what I call legal English, which only lawyers seem to be able to understand. It's very clearly designed to obscure, not to reveal. So basically, you have a simple company and a complex company. They have the same numbers. So think like an investor. Don't think about your DCF models, etc. Think purely as an investor. Which of these two companies would you value more highly? The simple company or the complex company? How many pick the simple company? How many pick the complex company? And if you open up my valuation book and start plugging numbers, what are you going to find? It's all about the numbers, right? Cash flows. If you plug in the numbers, I'm going to tell you they're both worth the same. You know why? Because in traditional valuation, we make this assumption that what you don't know can't hurt you. Deadly assumption, but we do it. It's a diversification argument. You buy 100 complex companies. What you don't know cuts in both directions. And until 2000, I used to let that go. But there's a problem with that assumption. What do you not know about the complex company? It's what managers have chosen not to tell you, right? Let me ask you a follow-up question. What do managers hold back? Good news or bad news? How many accounting scandals have you woken up to? But the company says, you know what, guys? We made 5 times more money than we told we did. Your surprises always seem to cut in one direction. Have you noticed this? There are always negative surprises. Nobody wakes up to a big positive surprise of an unknown. You're not going to be able to average out those surprises. They're all more likely to be negative surprises. So do we all agree that the complex company should have a discount on its value? You know, when this became an issue in 2001 when I was teaching this class, Tyco had an accounting problem. They forgot to mention like $3 billion in capex that they had. It's just oversight. It turned out that Tyco was a company, for those of you who don't know, was a conglomerate, grew through acquisitions, had done a lot of bad stuff in acquisitions, had hidden it under goodwill and impairment and restructuring charges. It all blew up. Tyco's stock price lost 70%. The week that Tyco lost 70%, GE lost 15% of its value. See, what's GE got to do with Tyco? How did I describe Tyco? Conglomerate that grew through acquisitions. And if you're a GE investor, what are you saying? Well, I have a conglomerate that grows through acquisitions. How do I know they're not screwing me as well? People viewed it as unfair, but clearly investors were punishing GE for being a complicated company. So I threw this out to the class. It's like this almost 20 years ago. I said, what do you guys think? Should we bring complexity in? They all said, yes, yes, yes. And then they said, you do it. I said, okay. To bring complexity in, we need 2 things. One is we need a measure of complexity, right? Without it, we're kind of stuck. And second, we need to convert into numbers. So I came to them with my first measure of complexity. And I'll tell you, even before I show you what I showed them, they weren't impressed. Here was my first measure of complexity. I just counted the number of pages in the 10Q and the 10. I know it's extraordinarily simplistic, but if you were picking a company to avoid valuing in 2001, which of these companies would you want to avoid at all costs? Take a look at Citigroup, 1,026 pages. This isn't War and Peace. I wish it were. This is how many pages it takes them to tell me what happened in 1 year. You're one hell of a screwed up company. If you take 1,000 pages to tell me what happened last year. They said, we're not paying, then it was like 120,000 for an MBA. Now it's what, 170,000 to count pages. We'd like something more sophisticated. I said, you're right. What was I thinking? So the next week I came back with an updated version. I call this my valuation shit list. It's basically all the things that bug me when I value companies and how much they bug me. And I'm bugged very easily, and I'm bugged a lot. So I built an Excel spreadsheet around the bug factor. So these are companies, for instance, that claim to be geographically diversified, but don't tell you where. Why the hell did he even mention geographically diversified? Or they tell you where, but you don't recognize any of the parts of the world. It's like a Lord of the Rings universe. He said, what is that now? I remember valuing BMW like 20 years ago. And they'd broken their revenues down into North America, South America, Europe, Oceania. And I'm trying to think of my geography class. Where's Oceania, Africa? No, it's not one of the continents. Maybe it's a lost continent of Atlantis. So I called the investment director, where's Oceania? She says, it's Indonesia, Australia, and New Zealand. I said, what do they have in common? He said, they're by an ocean. I said, really? That's your definition of Oceania? If that's your definition of Oceania, what's left, right? 90% of the world is Oceania. Then we have Latvia and a few other landlocked countries that are not Oceania. But from a valuation perspective, do you see what a problem it is when you bundle Indonesia and Australia in the same grouping? Why do I care about regional breakdown? To give an equity risk premium, right? Australia is an equity risk premium of a AAA rated country. Indonesia is an equity risk premium which is 3% higher. You bundle them together, who do I attach this risk premium to? So I built this spreadsheet. I came back and showed them the score. I'm almost done. They said, and I said, is this better? They said, much better. This is exactly why we came for an MBA. I said, there's one small cost to coming up with the score. To get the score for Citigroup, what do I need to do? Read 1,026 pages. I said, I'm not doing that. But each of you has picked a company to value, right? This is the train coming at them down the tracks. Too late to get out now. I said, this semester, in addition to valuing a company, why don't you do a complexity score? They bitched and they moaned, but they had no choice. But that semester, they came back with complexity scores for about 200 companies. And here's what they found. Larger companies were not more complex than smaller companies. Do you know how many pages there were in the Lyft prospectus? Did any of you take a look at it? 225 pages. Do you remember how many pages there were in the Apple 10K? 78 pages. I'm already worried about Lyft. It takes you 225 pages. They found that emerging market companies were more complex than developed market companies because they had more cross-holdings. They found that companies that grew through acquisitions were more complex than companies that grew with internal investments. And finally, they found that any company with a capital arm embedded in it was almost automatically 40% more complex. Ford Capital. You know what the most complex company in that class was? Think about what I've just described. Grows through acquisitions, has a capital arm. It was GE. My vision of hell, as I said, is to value GE over and over again, and you can see why. Everything that can potentially go wrong can go wrong. So have a good break. I will not send you emails for about a week. Okay? And then about Saturday of next week, you will start. I'll extend to you. Many of them are all expensive apartments in Manhattan and London with the so you could argue that there are vacant assets like that. As a percentage of value that's small, I'll tell you where these things become really problematic. Old European companies are notorious, not just art collection, their own chateaus, where the fat old Bettencourt, for instance, L'Oreal owns these chateaus that the Bettencourt family uses for family vacations. You could argue that you should be adding the value of the holding. The only problem is they will never reveal it on their own. You almost have to do it on the faith that they have it. Right? But I agree. Those AIG, for instance, the CEO of the old had this extensive art collection that was accumulated in company money. That should be part of the value of the company.
Leased out a bunch of other places to like store their staff while they're redoing the collection. But then you want to adjust, you have to like plan out your expected completion date for the reconstruction to end like the lease.
The question is the net cost changing that much, right? Because they replace one cost with another. And if you make the assumption the net cost is not changing dramatically year to year, the accounting numbers might change. But remember, there's an implicit cost to owning your building and using it. Then you're okay. But if there's actually a change in that cost, I'll tell you the even messier thing that happened in the late 90s when real estate in New York was soaring. Many of these companies that had real estate in New York decided that they were going to have their cake and eat it too. So what they did was they sold their building and leased back. That's a classic way you can, in cash, some of that mispricing. So I think that you've got to do